everyone, and welcome to our webinar where we're going to look at value from the perspective of fund management. Hopefully all will be quiet. I actually had a situation about 10 minutes ago where I saw my 10-year-old literally chasing her brother around the garden with a pitchfork in her hand and screaming, so they're both in their bedrooms now. I'll just warn you in case it goes mad during the webinar, but welcome and thank you very much for joining us. Hope this finds you all well. So cracking on, what are we going to cover today? We're going to share our research with you. We've been really for over the last year, a little more, asking the end investor what value is to them. And then we sort of spent quite a lot of time thinking about how that customer voice should feed through into the value assessments that firms are producing and publishing. And then I'm going to just check in. We did our last quarterly wave of testing actually the weekend after the market crash, and we've been particularly interested to see how perceptions of value have been impacted by that. So let's crack on. And I just wanted to show you, to sort of summarize the work that we've done really since January in 2019, when this kicked off. A comment coming through from someone that they can't hear. I'm going to assume that that is a one-off and someone will help them. Perhaps let me know if more of you have got problems, but I'll crack on for now. So back in January 2019, really we sat down with a blank piece of paper and said, we need to find out the customer view here. We want to understand what it is that the end person paying the fees at the end of the day values when it comes to asset management. And we did a lot of interviews with investors, and then we went out with a quant survey off the back of that. And after a lot of digging, we came up with our 4 pillars of value, which I'm going to touch on throughout the webinar. They are performance and price. That won't be a surprise to any of you, but also 2 other component parts: clarity and service. Now, clarity is really clarity both around objectives. Do I understand what this fund is trying to do for me? Do I understand what to expect? But also clarity of costs and charges. Can I see clearly what it is that I'm paying? Do I feel that people are being fair with me? And service, as we'll see throughout this, is less traditional customer service metrics and more actually trust, professionalism, brand, and some of those things we'll touch on. So all of that helped us to come up with a generic framework. We work with asset managers to provide to them, and that helps people to say, this is what the end investor thinks of as value. This is what it means to them. Now, what we've then been doing is every 3 months going back into the field and doing it on a brand specific level and actually starting to track what it is that end investors think about specific brands, where they offer value and where they fall down. This is how we then work with firms. There's an overall generic value report. I'll show you some excerpts in this webinar of the quarterly value tracker. That's at a brand specific level. And actually, really interestingly, we've been working and are working with some firms now in how you actually communicate value to the end customer. I've got some comments at the end on some of the publications we've seen to date. So I've talked about the 4 pillars of value. Now, performance is the most important component part of value. No surprises there. We didn't need to do research to tell us that. But performance is key to people. And actually, performance is also a very relative thing for the end investor. So how is it done compared to a peer group? How is it done compared to others? And interestingly, how is it done compared to cash? I'll touch on that in a second. Costs, again, are key. Not necessarily in isolation, because people really don't know what to expect, but that relativity to peers is as important for costs as performance is. But 2 other things I want to sort of touch on this webinar. I've talked about clarity already and that peace of mind, and that's such an intrinsic part of value, and that's very obvious when we talk to people at the moment. And that is something that is typically overlooked by most asset managers in the value assessments I've seen. And service, okay, not just call centers or error rates, but actually this comes down to confidence and trust in the brand. Do I trust that group with my life savings? And what we've done is then we've really dug into more detail and talked to people about specific funds and got them to tell us what it is that they value. And we've weighted all those component parts, which typically fall into one of our 4 pillars. And I'm just showing you the sort of top 3 here. And that top line, so difficult for asset managers really to sort of know what to do with this information. We know that people benchmark funds against cash. Of course they do. It's the opportunity cost of investing for people. So even though that may not be your objective as an asset manager, that is the first thing that people tell us they want to see to compute this. And it's interesting to see how many, or actually I should say how few of the value assessments have talked about cash and cash returns and how funds have performed compared to cash, when we know that's the number one thing investors, these are fund investors, want to see. That relativity to other funds there, so that people want to see a peer group. Now that peer group they want to see is quite narrow. It's certainly more narrow than an IA sector or a Morningstar sort of defined sector. They want to see returns in line with 5, 6, 7 similar funds. And then clarity of information, look at that sort of third there. I feel they are clear and transparent with me. One of the things that came out when I was interviewing a fund investor, he really liked Terry Smith was cited, the video town halls that are done. People also have cited Adrian Frost from Artemis when he writes, is sort of very clear and transparent. Lindsay Train as well, when they sort of write their quarterly updates, they're very well written and succinct. And actually it tends to be those funds where the asset manager is actually a good communicator and is writing those updates in a clear and transparent way that people really value. So who has listened, and I'll sort of come to this a bit more. I've spent some of this lockdown, it makes me sound really sad, sort of looking at all the value assessment statements that have been published and making my notes on good practice, what's good, what's less good, and we'll be publishing that over the coming month or so. But some interesting things here from Aberdeen at the top there, Aberdeen Standard. We consider factors such as customer sentiment. They have actually gone out and talked to the end investor about what they think when articulating quality of service. Hargreaves Lansdown are actually one of the best at understanding the quality of service element of value. Of course, they are good at that. They're very good and experienced at understanding the end customer. A really interesting thing here, they see transparency is an important component part of value. And I think they're right there. And they cite that in their quality of service. Rathbones down at the bottom, you can see we also measure our fund's performance against a cash benchmark to give you an idea of how your money would have grown in a UK bank account. I really like that. It talks to what we know are the questions people have. Rathbones, again, an example there, they show transaction costs. That is what people want to see. People want to see the all-in costs of a fund, and they want to understand performance net of all costs. It's good to see that included. And then Vanguard on the right-hand side of the screen, comparable market rates. People want, we know they've told us they want to see the total charges, total all-in charges compared to peers. How much does this thing cost compared to some of my other choices out there? So thinking about the customer voice, really over the last 5 quarters, we've talked to nearly 9,000 fund investors and got them to tell us really specific things about what it is that they value from funds. You can see here some of the questions we're asking at a brand specific level every quarter. Performance in relation to charges is frequently cited. But also I've pulled out some things here that we don't typically see asset managers report back on at the moment. The clarity of the communications. Do I feel that I know what's going on with this fund? Do I know what to expect? And I've pulled out some of the adjectives there: honest, professional, prestigious, reliable. When we read all the verbatim comments that we collect, we get a picture of these softer parts of value, which are typically overlooked by industry analysts, and some comments in there. They provide an excellent service which does not confuse me and at a reasonable cost. That's a very reflective customer comment there. Negative comments tend to centre very much around charges and performance in light of those charges. And I've just got a swathe here of some of the sort of comments from the people from the last quarter we talked to about, when you say that a fund offers you good value, why is it? What is it that's making you say that? And I've just pulled out in pink here, just to sort of evidence, look at the sort of proportion of the comments that really go to that sort of clarity of comms and the service, the word professionalism and that sort of peace of mind, the excellent service. There's a few comments as well I've sort of picked up on, prevalent this quarter as you'd expect, with people who are investing for income and for whom it's about yields and dividends. But the main point I want to make with this slide is trust, okay, and perceived expertise and professionalism, such an important part of value. And I think that falls into the quality of service bucket there. And it's something that's been broadly left to one side in value assessments to date. And then the not good value, I mean, here are sort of some of the comments. And of course, we can map these at a brand specific level. So there's just a generic bunch here for you, but it's largely, as you'd expect, around sort of performance and fees. Quite often the two are sort of evaluated at the same time. Just showing you a chart here. I've blanked out the specific brands so you can't see who they are, but we ask people to assess value in light of those four pillars I've talked about. So charges and fees, performance, clarity, and service and brand. And there's just a few sort of points I pull out here, is that the overall rank is not just a sum of the component parts. So people are asked to say what they think about charges and performance. And sometimes when we go at the very end and say, so give this brand an overall value score, they do much better than the sum of their parts. Sometimes it's the other way around. But for some brands, there's some really interesting differences, which I think highlight problem areas for them or things to think about. You can see I've highlighted one of the circles there. A manager does particularly well for overall performance, but quite poorly for charges and fees. You can see there's a 6.2 there for charges and fees. That manager is Fundsmith, and I think that's interesting, and it's absolutely reflected in the verbatim comments from end investors. Those end investors, largely DIY, actually end investors, but they recognize the good performance, but they also recognize what they think are fairly hefty charges and fees. And that's just one example I've pulled out. There's some dissent from some asset managers who don't see the merit in asking customers what they think about value because they think people don't understand it. That is not borne out by the comments that we see. I've circled there 7.4. You can see overall service and trust in the brand manager. That's Bailey Gifford. And I think that's really, really interesting. You look at the discrepancy there. Now, these are perceptions. Okay, I'm not saying these are the facts, but the perceptions are that people do actually really rate and trust that brand, but there are some hesitations you can see there about the fees and charges. That might just mean it's how they're being communicated rather than what they actually are. And in the bottom corner, you can see a 6.6 there for overall service and trust and brand. That's one of the largest asset management brands in the UK. And I think a sort of real cause for concern there when we dig into those verbatim comments, what's underpinning it. So there's some really interesting differences that come out from what customers have to say about the brands they use. We also, as well, I've taken the brand names off here, but we are able to split the customer responses according to who's an advised customer and who's a DIY investor, and some really interesting differences here. Now, typically advised investors give value sort of ratings that are higher. They see more value. So the average value score is 60% for an advised investor. For a DIYer, the average value score they give to asset managers whose funds they hold is 50%. And I pulled out again some of the discrepancies. Now, there are brands whose DIY investors rate them more highly for value. And some of those brands you would expect, they're the ones that tend to have the sort of very loyal DIY, slightly savvier hobbyist customers. Bailey Gifford is one, Marlborough, Lindsell Train. At the bottom there, I've highlighted that's in fact Marlborough, who get overall, actually, I'm surprised, a relatively sort of poor assessment this quarter from end investors, but a much better ranking from the DIY brigade. That's 45% there compared to 30%, just 30% of advised investors talking about value. I've pulled out on the right there, that happens to be Merion, and you can see a huge discrepancy between the value assessment from advised customers, that's 79% saying yes, offers decent value, compared to 32 for the DIY brigade. So some really interesting insights there into how groups are perhaps spending their marketing budgets, who they're talking to. And some of the larger UK brands actually have the really big gulfs between happy-ish advised customers and less happy DIY customers. So how has value been impacted by recent events? Well, we asked our boring money readers post-crash what their intentions were from an investment point of view over the next 3 months. We were just sort of taking the temperature there, and look at how many people said, actually, I see this as a buying opportunity, but they were planning to buy using trackers there. You can see 34% saying, I'm going to use some sort of passive strategy to buy the dip effectively. And that sort of rush in a way to passive, or is mirrored in the research we've done with the fund investors about value. And we really saw this quarter the passive managers do much better than they had in 2019 in terms of value. And in fact, Vanguard were ranked first out of the 30 managers we test for value, and that's not happened before. But we can also see an increase in ranking this quarter for those larger, kind of more global brands, as this becomes a story of sort of trust, of peace of mind, of service for end investors. And forgive me, I did this slide, it looks a little bit ugly, but I wanted to show you the overall rankings from this quarter and split them by types of asset managers. So in the very far right column, you can see the rankings for this particular quarter. I put Vanguard there. They were top this quarter. But it's so interesting to me, you can see that the larger global brands, which are also well known and marketed actively in the UK, have done so much better this quarter. And some of those UK-centric brands that are very focused on this market, I've shown them in green, have kind of fallen from grace. You can see one, the top sort of green one in the chart there, was ranked 11th overall for value this quarter, whereas consistently throughout 2019, they were ranked 4th. So a real sort of fall off there in terms of perceptions of value from customers with smaller local brands. And some of those larger sort of North American brands, less known to retail investors in the UK, have also fared comparatively badly. A quick word then on the published value assessments to date. And we do actually have a webinar coming up on the 4th of June. We're doing that with the FCA, the IA, and PwC, and we'll be looking very specifically at value assessment statements. So do get in touch with us if you'd like an invitation to join that webinar, where we're really going to be unveiling our best practice and what we think a good value assessment statement looks like. A couple of things I'd observed just from reading them. I think quality of service, so important for the end investor, is typically the weakest section. I've pulled out a few examples here. The top bar you can see is from the Merian report. That was it. That was what they had to say on the quality of service. There's no evidence base there. It's based on a belief. We believe that the funds have delivered this in context of quality of service. On the right there, that's from the Morgan Stanley value assessments. Again, it's very much someone marking their own homework. It's based on a belief, where they actually list what I think are nothing more surely than hygiene factors for an asset manager, such as a good fund operations team and experienced investment professionals at the helm. On the left-hand side, I've pulled out Vanguard there. I actually think the Vanguard statements are one of the best that I have seen. I love the fact they continually ask the question throughout it, how can we improve? Surely that's the whole point of doing these statements, and yet they're really the only one that continually ask themselves that question throughout. But again, in assessing the quality of service, they've not gone to their end investors, and they haven't actually asked people, again, marking their own homework. So I think typically that section is an important section, and it's poorly done. I'm also just very intrigued that the FCA's non-exhaustive list of 7 points that they suggested groups look at has been by and large used as the reporting standard, and actually just wasted paper, because it's typically a cut and a paste. If you look at economies of scale, comparable market rates, classes of units, there is typically a couple of sentences from each firm reporting back on that, which is just repeated and cut and paste on every page. And the amount of information there is minimal. I just wonder why groups have chosen to report back that way. And in a chart there, you can see from Vanguard, some of those smaller points are given as much space and time as the all-important quality of service and performance. And I just think there was a really interesting example here from Aberdeen Standard, who didn't actually follow those 7 points in their value assessment reporting, but went for something which to me feels a lot more logical and intuitive. Then they grouped their pillars into 3 parts. You can see their service, performance, and cost. And they'll tackle all of those FCA points in those 3 main headings. But that to me felt like an alarmingly sensible way to approach the value question. So just sort of in conclusion, I've rattled through what we do there. I hope it's provided useful food for thought. But just a reminder, you cannot articulate or evidence value if you don't ask your customers. And we have to go back to the drawing board, I think, and really listen to what people tell us it is that they value, and to think then about how we report back our value against what it is that people want to know. And I really, again, just sort of leave you with some sort of comments there from investors, both advised and non-advised, about what it is that they value, because this will look very different to an industry fund analyst's assessment of value. And just concluding from the sort of recent research that we did, despite the falls in March, value actually held up. Across the board in 2019, the average score, value score, given by those nearly 8,000 fund investors we talked to across the year, I've written it down here, was 54%. So that's 54% of fund investors saying, yes, I think my fund offers good value. That was a very binary question, 54%. In Q1, after the crash, that just fell off 1 percentage point to 53%. So actually perceptions of value were relatively strong. We've also seen largely consistency. 7 of the top 10 for value in Q1 were also there in Q4. But what we've noticed, and I've talked to this webinar, is brand, professionalism, expertise, peace of mind. I feel like they know what they're doing. They're a professional, strong team. All of that is sort of so important at the moment. So we've seen the strong retail brands perform relatively well, but also passive funds. People, we saw there from the buying intentions of people planning to buy the dip using passive strategies, and people actually giving passive funds this quarter a relatively higher value score than they have in the past. I've touched quite a lot on the quality of service module, which I think is weak. I was obviously in quite a bad mood when I wrote that. I put borderline arrogant. That's perhaps a touch aggressive, but I hope not too unfair. And that customer voice is lacking. I think a final point, it's very interesting to me how many fund managers think that these statements will be of absolutely zero interest to the end customer and park them at the end of annual reports. I think actually, if these are well crafted, they answer immediately a lot of the key questions that end investors have. So what role do these have in the reporting suite of materials that people produce? It's an interesting question. I'll leave you with the obligatory here's what we can do for you message. We have the first report we have is that generic, this is what people value, folks. You know, this is the weighted input, the list of components of what it is that your customers value and how you need to think about that. We also do this quarterly tracker where we can come back to brands with very specific research on what your end investors think and say and want, and where there's room for improvement, how you're doing compared to peers. And we're feeding through into the quality of service reporting modules there. And finally, do come and talk to us. We're working on a few digital value assessment statements, which we are also testing and creating with the end investor, so that we know people understand them, they do what people want them to do, and they deliver the relevant information. That is it from me. We have a webinar, our 5th webinar next week on advice and guidance, a slightly different topic for a different audience. And if you're interested in that webinar we're doing where we'll very specifically look at best practice and value assessment statements, that's with the FCA, the IA and PwC, then please drop us a note and register yourself for that. That's coming up on the 4th of June. Thank you for listening. I shall now go and let my children out of detention from their rooms and bribe them with pizza to be nice to mummy for the rest of the day. Thanks very much, guys. Bye-bye.